we'll talk about venture in crypto and what's next for crypto VC. So VCs have played a super important part in Web2. Like super iconic companies like Google, Facebook, DoorDash have contributed a lot of their success to the venture capital investors. And there's some legendary investors, Alfred Lin from Sequoia, Katie Haun, of course, from Haun Ventures, and previously A16Z, amongst others. So we'll talk about crypto VC or venture in crypto, or like we'll figure out what exactly, or is it venture dollars in crypto? So we'll unpack that a little bit and talk about other things. We have a fantastic panel with us. We have Dan Chen, who's currently an investor at Sequoia. Previously, he was from 2014 till 2017. He was at A16Z, so super OG, and built a number of projects in the space. Sam recently launched his fund with Katie Haun, Haun Ventures, and he was previously a general partner at Polychain, and before that spent 5 years at Coinbase. Also started the Coinbase Ventures team. She was at Galaxy, and before that she was at other venture funds, and most recently heads up digital assets at Matrix. Sam, starting with you. You were 5 years at Coinbase. You interacted with VCs who were both crypto native and non-crypto native. What was your experience?
Yeah, we were very fortunate at Coinbase from quite early on to have backers like Union Square Ventures and Andreessen Horowitz that really were seeing around the corner, I think, ahead of many other firms at the time. So, obviously at the time, the space was much smaller, very different looking. But I think folks like Fred Wilson and Chris Dixon back then did have a sense that this was going to be quite different than what had come before. And I think that sense led to maybe more open-mindedness in how we were operating and how they wanted to partner with us to operate. Over the years, we ended up bringing in a lot of firms that were investing in crypto for the first time. We're backing Coinbase as that first crypto investment. So I like to think Coinbase as a company had a lot to do with a lot of venture firms kind of converting over and starting to do some crypto work. And
was there any instance in which you thought crypto investors and Web2 investors disagreed?
Oh. I probably won't comment too much on that, but I'll say, yeah, certainly you can see some of the folks that are still quite heavily involved in investing in crypto today, were maybe some of the folks that were very value additive to Coinbase early on.
Dan, Ira, you guys have Web2 and Web3 colleagues. So Sequoia famously is a very, very large Web2, like traditional fund as well. Amongst the general partners or investors, do you think there's something different about crypto investors versus not?
Yeah, that's a very good question. Also a kind of tricky question to answer. I would say that crypto is new and different in a lot of ways, and I think one of the things that we have started to realize at Sequoia is the depth of the community and the explosion of growth in crypto over the past previous couple of cycles. And the space now is so much more vast and deep than it was even in 2017, 2018. And we have kind of a generalist model at Sequoia where partners will partner with companies ranging from crypto companies to digital health companies to enterprise SaaS companies to consumer social. So there is a little bit more more pressure to be deep across all these various spaces. But I think crypto has just grown so quickly that we've seen even more pressure to go further on the crypto side. And I think that's where we're at now, where we are at a point where we are, building up the fund internally in terms of, coming to terms around the space, the breadth of, everything going on in Web3, from DeFi to NFTs to DAOs to, all of the similar kinds of projects that were happening in 2017 to infrastructure and whatnot. And, we're kind of bridging the two is, I would say, the overarching thesis.
Yeah, I think for us, Matrix, the traditional hedge fund, has been around for like the past 2 decades. People underestimate actually how TradFi people start to incorporate this. My colleague, they're degen, they farm, they like participate in constitutional law. I didn't even know that part. So it's actually people nowadays, the Gen Z millennial investor has been a lot more reciprocal to the whole entire crypto product. And I think the interesting part is, I think for team with crypto team compared to the Web2 team, the difference is, I think the crypto team will be a lot more like hands-on, like operation, and also like testing the product. Like my colleague is literally participating in hackathon, trying to fill out the product, is that actually working? So I think that's, the builder mentality is actually a lot more incorporated with Web3 investor compared to the Web2 investor, I would say.
And have people pivoted from investing in Web2 to Web3 at Matrix?
I think we're parallel. I think Web3, if I think about it, is really the convergence between, think about the internet investor and also the fintech investor come together, right? So I think there's a lesson to be borrowed across different sectors, and that's actually the beauty of this industry as well.
Got it. I want to briefly talk about fund structures, because I think for a long period of time, people could just not hold crypto. Funds could not hold crypto. And I know that the 3 different fund structures out here. So I want to briefly touch on them. Do you want to talk about how Sequoia, the recent changes in Sequoia?
Yeah, so Sequoia, registered as an investment advisor, and part of this allowed us a lot more flexibility with the assets that we could hold, crypto included. But it's interesting kind of looking at the historical context of the space and how it's kind of evolved over time, where maybe in 2016, the primary way that institutional VCs who have had, quite honestly, quite a bit of crypto exposure over the years, even dating back to when Bitcoin was the primary assets, the institutional VCs themselves couldn't invest in crypto. So the primary way that they got exposure was through investing in funds like Polychain, Metastable, but they realized in the previous cycle, as tokens became the primary fundraising model, that they needed to adapt to it. And I think what we're seeing now in terms of the shift of fund structure is an adaptation to the rise of tokens and the rise of all of the kind of regulatory compliance that comes around with it.
Sam, you set something up recently.
Yeah.
How's Haun Ventures structured?
Yeah, so Haun Ventures is just a vanilla venture fund, exempt fund today. I do think crypto as a whole has had a pretty big impact on the way that firms are having to think about their structure. And Sequoia is a great example of this. Polychain, where I previously worked, had actually both a hedge fund and a registered venture fund. So I think the last 5 years, this part of the story of the last 5 years has been venture capitalists and investors trying to figure out how to best, more or less, deploy the capital into the projects they want to deploy into, and having to accommodate that structurally. So we are today just a vanilla venture fund structure. So we'll see if that ends up changing in the future, but that's where we are today.
And so just to be clear, you can hold about 20% of your balances in tokens and other things.
Yeah, and ultimately, I'm sure we'll go beyond that, and that may end up entailing some structural change. But for the time being, we are exempt fund, and based on the types of investors we have as our LP base, we do have some flexibility to invest into crypto coins and tokens as well, and we have done that, and we'll continue to do that.
Yeah, I think for a hedge fund, we're slightly different. Like, the biggest difference, I think, was like last year was the first year the institution actually in the space. They were like playing the game, and what we have seen is literally nearly about 12 large growth equity and also hedge fund. They actually changed their mandate in the past 2 years to incorporate holding more alternative digital assets. So that's a really like an encouraging signal for us to see how the space has been out there as well.
I want to talk a little bit about deals and deal structure. And in particular, I want to talk about this weird nuance of tokens and equity and value accrual, which happens in 2 spaces, probably, instead of 1. How do you guys think about it? What's been unique, weird, interesting about it?
Yeah, I'll go first. So it is a fundamentally different fundraising model, and it's something that we've had to wrap our heads around. Obviously, there's the 100 Prime Gorilla, which is liquidity aspect of it, and how do we deal with liquidity. But it's also kind of like coming to terms with the the various models where it used to be SAFT and then SAFE and SAFT and how these kinds of things have evolved over time. I think at the end of the day, we're still seeing quite a bit of flexibility from founders, especially at the earliest stages when they're still structuring their companies, and they're thinking about what is the right model that we should go through. Should we go pure equity raise from now, maybe add on tokens later? Should we start raising tokens off the bat? Do we do token warrants? And I would say the primary model is probably more of a split of the two, but it's also very dependent on what space the project is actually in. So if they're a little bit more kind of deeper down the Web3 rabbit hole, they're probably going to do token warrants or one-to-one token equity splits.
But sorry, imagine that there was a company or there was a network which gave 50% of their tokens to the equity holders versus another one which gave 10% versus another one which gave 90%. Exact same company. Is the valuation different from your perspective?
Yeah, I mean, the effective price is different, right? And as a VC, obviously you want to have more of the company, and the way that we kind of approach it is through more of the traditional kind of VC model where you have various ownership targets. And a lot of this is driven by, over the past 50 years of venture capital, the primary model is you partner closely with your investments, you work to build them up, you are partners, effectively co-founders through the process. You're working your asses off for the company, right? And that model has shifted a little bit with the token model where, the effective ownership, it gets diluted very, very quickly. And, as an investor, you don't own nearly quite as much. But, there are some benefits of this, which, we all know, which are, you have some more tokens in the treasury to potentially, go towards community development. And we're seeing, these new companies play around with these various models around go-to-market and community building that you don't see in Web 2, and to varying levels of success. But at the high ends, the upside is incredibly high. So I would say that there's no solid answer here, but there are trade-offs that we consider where I would say we're not 100% price sensitive, but we do have ownership targets. But at the end of the day, if it's a great project and they're building a world-changing technology, then it's interesting for us to be a part of it.
Yeah, I think we are all still sort of learning in the grand experiment of crypto incentive alignment and value accrual. And I think of those three options laid out, interestingly, you probably wouldn't want to invest in the company that was holding 90% of the tokens to themselves and only distributing 10% to the community, because no one's going to use that. So I think the experiment is where is that perfect balance struck where you have value accruing to whatever you've invested in as an early investor. Ultimately, we are in the business of returning capital to LPs as well as backing great projects. And so you have to be thinking of the value accrual and the timeline to that. But as crypto investors, I think we're all thinking about, well, how do you make this company or protocol or project become impactful and motivating to millions of people around the world? And I think the value accrual piece and where tokens are going ends up having a lot to do with that. So I don't think we've seen the definitive answer to the question in terms of what's the exact right answer. I do think we're all starting to see this concept of hyperstructures where you have a project team that creates a protocol and then ultimately then goes back to focusing on revenue creation as a business. And so as early investors, I think we all try to make sure we're aligned incentive-wise with the founders, and that might be a combination of equity and tokens as a result.
Yeah, I think to echo on that point, if I flip the question back, it's also like, to founder, not only think about product, company, technical, what's your token design model, right? If you don't have a clear answer, you're figure out on the way, that's another question you probably should think through when you start to begin the project. So that's not only a question for VC, but also like how you think about your vesting, how you think about distribution to like your team, your like customer, your user to VC. That's actually something you should consider since the beginning as well. The other part I want to mention is for token model, it's actually like a more like go-to-market strategy, right? How you create an incentive with your user, AKA also like stakeholder in your ecosystem. How do you create that incentive alignment is critical, right? So that's how when we value company, of course, if we own 90% of the token, why user want to be engaging, right? What's the difference? So that's actually like a very interesting topic. Like I think this space has been really focused on since the 17 days actually.
I want to talk about some weird things that happen in crypto. Have you guys backed any anonymous founders? Or is that a hard stance of not backing anonymous founders?
I can jump in. So no, we've not done any primary transactions with founders that we don't know face to face, or at least Zoom to Zoom. But no, I think it's a great question because over the long run, I mean, ultimately, some of the investments that we make will be secondary transactions to participate in a DAO or something like this, and you know, maybe we'll see how that ends up shaping up. So far, we've only backed founders that we know.
Yeah, typically the founders end up doxing themselves sometime through the pitching process.
Yep.
Yeah, we chat with a lot, but yeah, similar situation right here.
Would any of you back a project that has vampire attacked another project?
That's you're asking the hard-hitting questions here. So I think as far as vampire attacks go, and I like to directly answer your question, it has a tricky connotation in the space, and I would say that we probably lean a little bit skeptical, and I think part of this is due to if you look at how vampire attacks have played out in DeFi. Well, there is protocol and liquidity as a response to vampire attacks, but probably the primary example is Uniswap versus SushiSwap, and if you kind of fast forward to today, Uniswap obviously is the dominant AMM, and Sushi has fallen off just a little bit for a variety of reasons, and I think that at the core, what we're really looking for is the number one, the kind of developer momentum and founder momentum behind the project. But number two, the community. And it's always incredibly important. And I think there's something about building a deep community that isn't necessarily as mercenarial with their liquidity that, is kind of the antithesis of vampire attacks. That said, it's not a necessarily novel concept. Like we've seen this in Web 2 before with, probably the most notorious case of vampire attacks in the real world was, Uber was very aggressive in some of their kind of go-to-market strategy in the Uber and Lyft wars. So, it's not a particularly new concept. It's new in the DeFi and Web3 space and in this particular iteration of it. But I would say, probably long-term, good to experiment with these kinds of models, but we probably need a little bit more long-term justification for them.
Yeah, I can't think of, off the top of my head, I can't think of an example of a vampire attack where 12 months later, that project was sort of the leader of the space. I think, at least in the ones that comes to mind for me, so far, we've not seen that transition, and ultimately the kind of original project is the one that continues to persist. So I wouldn't say that we wouldn't back something because they implemented that tactic, but I think we are long-term venture investors, so we're looking for sustained value creation over time as opposed to something that's a flash in the pan for a shorter period of time. So I think we probably haven't seen, and I mean, to your point, we've seen the Uber and Lyft Web 2 version. I think we haven't seen the final version in crypto yet, and I'm sure we'll start to see vampire attacks and counterattacks, and there might be more interesting things to come there. But yeah, ultimately, we care more about the long-term value creation and the community around it than we do about specific tactics being deployed in go-to-market.
Yeah, I think for us, two-part. How many ETH2 killer are out there? right? Like, I think like that's like not like a binary question answer. It's more like, I think market's still big enough. Like there's still a lot of things to be built, so we're not too worried about that part. The other thing is, when I think about like the golden rule in crypto is people think, oh, the first market advantage. But the reality is sometimes V2, V3, V4, actually the iteration, the forkability, you kind of improve upon the time as well. So sometimes the V3, actually V4 will win over the market, surprisingly. That's kind of slightly different from the Web2 economy we see there.
I think implicit in that V2, V3, V4 is that the team is motivated to build out V2, V3, and V4. Now, one of the things that happens is liquidity comes very fast, or I think you said it, like Series A is an IPO, basically. So how do you guys sort of sense for that when you're investing in your companies?
Yeah, no, we were talking about this earlier backstage, is like how you think about, public equity market in this space. Essentially, you're looking at Series A go to listed like since day one, right? Almost a pre-funding model. That's a reality. Like that's what VC have been dealt with. And the other, if I flip the question back, is also how, as an investor, what's your strategy? Not only just invest in the whole, it's testing our capability to liquid strategy, active management, governance, proposal, right? So there's actually a lot more work for us to think about holistically to tackle the space as well. So that's what we're thinking. And what's the duration of your fund compared to your project? How they're listing liquidity prospects is another equation we have to factor in as well.
I love the fact that things are called projects at times, which is like technically true. It's like some of them are actually not companies. Talking about like the incentive alignment, we haven't seen outside of like Coinbase and some of the other who are closer to the spectrum of like a Web2 company as opposed to a DAO, if that was the entire spectrum. We haven't seen companies around for a decade. If I told you a lot of this did not make it, what would be the one reason what happened?
Yeah, I think you brought up an interesting point with incentive alignments that we've seen probably over the past 10 years with crypto. As 2 cycles ago, maybe everybody was Bitcoin maxi. Previous cycle, there was a pretty big divide between the Ethereum community and the Bitcoin community, and there was talks of the flippening. And this cycle, it feels like there was a big Ethereum versus Solana and various alt L1 battles that's going on. And the technology is changing very rapidly, and I think on the VC side, what that translates for us is what are the long-term moats. And if you look at the early internet days, if you look at '98, well, a lot of the price action there was driven by the early liquidity, so not very much unlike what we're seeing right now. But what I would say is that like one of the things that we're trying to grasp in the space as a whole is what is the long-term moat for a project, especially when from the incentive side, founding teams or early employees might honestly have way too much early exit liquidity just because the project explodes and the fundraising environment is very good and there are secondary options and the markets are very liquid. And historically, you've kind of seen this where the developer momentum has kind of hopped from community to community, starting with Bitcoin to Ethereum to kind of across the alt L1s right now, and long term, regardless of whether you're BTC maxi, ETH maxi, whatnot, it's still kind of TBD what ends up panning out, and it's tricky as a venture investor to like when the goal is to have like a partner with a legacy project that lasts for decades to kind of think through that. So I would say the easy answer is it's early and we're wrapping our heads around it. I'd say maybe a little bit more nuanced is I think it is something that needs to be addressed by the space, and I don't know if it's through better lockups and more maybe a little bit less fatter flexibility, more incentive alignments. But I think in the long run, the space will get to the right points in terms of how to structure these things and make them sustainable projects for the long term.
We're almost at time. Closing remarks. Where is crypto VC headed?
I think the future for crypto VC, one, hands-on, you have to have a builder and operator mentality, not just investing. You run a node, you have to do a lot more work closely with the team. Right? I think that's, for us, that's what we're thinking for the next chapter for crypto VC will be.
Yeah, we think of this internally at Haun Ventures. We talk about the three things that venture firms need to bring to crypto, to the ecosystem. I mean, one is obviously just capital. We help allocate capital in the right places. Two is services for the teams, for the founders. So that could be anything from go-to-market help to governance to executive placement. But then the third, and I think one that this is kind of brand new given where the ecosystem is today, is system change. And we talk about that from the perspective of Haun Ventures, that might be public policy or PR and comms to the broader world. But ultimately, it's making the IRL world accommodate everything that we're building and everything that our founders are building in the crypto world.
Yeah, we're looking to partner with legendary and enduring companies. And as I said before, crypto is still incredibly early. And there's still so much more for the ecosystem to evolve and to be built. And again, it reminds me of the early .com days where of course there was quite a bit of froth in the financial markets, but at the end of the day, you also had the Googles and the Amazons coming out of that cohort. And we're looking for those companies where when the dust settles, they are the enduring, sustainable businesses.
Thank you very much.